I'm welcoming you to this new lesson. Here, in the earlier lesson, we have prepared the accounting equations, and for that, these exercises we have done the exercise, and hereafter again we what I plan to do is I want to prepare the trial balance and T accounts for you all for this particular accounts. Then only you can understand how you can perform with this. Okay. Here, what I will do is I will prepare the trial balance here. Okay. This is the trial balance. Balance. Right. Trial balance will look like this. Okay. Okay. Yeah. Portfolio. Okay. Description. Okay. Account heading and description. This is debit and this is called as credit. Okay. This is called trial balance. Okay. Here we will use to say ledger for your number. Okay. I will put like this. Ledger folio number. Okay. Number. LF no. Okay. And here we will say description. Right. This is we do not like this debit, and here we will say credit. Okay. Debit and credit. Okay. After we can open the T accounts whatever we need. First adjustment says trial balance of DVR traders. We have to take trial balance of DVR traders. Traders. Okay. Here, first adjustment says investment by owner for 500,000. Open a T account for that. Right? Investment. First of all, we have to open a T account for cash account. Cash. Cash. Okay. Here it is debit side and here is credit. Okay. This is cash. Debit and credit. I think this space is not enough for. So I'm raising this one. I would like to enlarge this account. Okay. Here I will say we can expand it like this. Okay. This side is debit and this side is credit. Okay. Here we have to say this one is cash account. Okay. You understood? This is the cash P account. Here, if you see investment by owner 500,000, then cash account is going to affect, and other one is capital account. Okay, capital account. We are going to open capital account. Okay, capital account. Okay, this is credit. This is debit side. Okay, the account. Here you will see he is bringing an investment by owner 500. Then you are going to debit the cash account. Cash account debited. This is the debit side, and you are putting 500. Okay, and you are crediting that to capital account. Capital account. This is the capital account. 500. Okay. So the double entry is done, but you have to give the references. Here you will say capital. Alright. Here you will say cash. Now the double entry is completed. Okay. Because investment by owner means he is bringing the cash account debited. If it is coming, we are receiving, then debited. Capital account, we have to pay him some other day that amount, then it is credited. This one is credited. One is debit, one is credit. Okay. Next is the business borrowed 600,000 from bank. The business borrowed 600 rupees from bank. Cash account debited. We don't need to think twice. Cash account is debited. If they mention in the question cash, then definitely the cash account will be affected. Neither cash or debit or credit. Either cash or cash in either debit or credit in cash. So cash is debited and bank account. Okay, we have to open a bank account. We shorten this out and we are going to open a bank account. Bank. Here we say DR and CR. Account name is bank. Okay. Bank account means cash is debited, bank account is credited 600,000. That's why we have received a loan in the sense cash is coming in, then we are debiting it because asset is increasing, and bank is credited because we are liable. It is the liability. We have to pay him. One day we have to pay him. That is, we don't know. They have not mentioned when we have to pay. But in future, we have to pay it, repay. So we are showing that as liability. So bank account is credited. Bank loan. It is better to say bank loan account. Bank loan. Loan account. Okay. Here you say cash. Okay. Cash. Here you say bank. Bank loan. Okay. Bank loan. That's all. So you may understand here what is the effect. Cash account, it had an effect on cash and the bank loan account. Right. Third one is purchase of furniture for cash. Purchase of furniture for cash. We have to open now a furniture account. Okay. We have to open up a furniture account. This side is debit and this side is CR. Furniture. Furniture. Because purchase of furniture means for the cash account credit 200,000. Okay. Furniture account debit 200,000. 200,000. The reference is given here to furniture. You say cash. Here you say furniture. Okay. Then the double entry is completed. This is also asset. This is also asset. There's a increase in the assets. Furniture increasing. Cash is decreasing. Decrease in the assets. So within one asset category, both things taking place. You know, as you know, earlier we had the I had explained you in the accounting equations. Okay, so fourth entry is furniture. We have purchased the furniture on credit basis for 700,000. Now, furniture account, we will say 700,000, that is debited, and we are going to say that debtor, creditor, other creditors account, right? Other creditors. Okay, this size is DR, here is CR, and what we'll say is here 700,000. This is other creditors. Okay, other creditors. So here you will say other creditors ABC Limited. Okay, this is ABC Limited. Okay, here we will say ABC account. This is the one. Here you will say furniture. And check. Okay. So double entry is over for number 4 adjustment. Number 5 is inventory worth of 100,000 purchased for cash. Next adjustment is for inventory. Okay. This is CR. Okay. This is BR. Inventory. Inventory account. Because she says inventory 150,000 worth of inventory was purchased. Inventory account debit 150,000. Cash account credit inventory 150,000. Okay. Here we will say inventory. Here we will say cash. Okay. So adjustment number 5 also finished. Next one is adjustment number 6. Inventory purchase on credit from A for 200,000. So inventory purchased 200,000 is debited to inventory account, and again we are going to open trade creditors account. Okay, this is DR, this is here trade creditors. Okay, trade creditors is creditor. Why? We are we have purchased 200,000 worth of inventory on credit. Inventory is coming into the company, so it is debited, right? And we have to pay for this in future, so this is creditor. Okay, then here you say inventory. Here you say trade creditors. Okay, now we will move to adjustment number 7. Inventory worth of 50,000 sold for 70,000. Inventory worth of 50,000 sold for, then cash is coming in, cash 70,000, and open a sales account sales account, here debit and here credit. Sales, all the time revenue is the sales is the revenue always credited. Okay, cash account debited, then revenue account we will say 70,000. The reference is cash account. Okay, so double entry has been passed because when you make a cash sales, cash account debited because cash is increasing and asset is also increasing. So if the asset is increasing, we have to pass a debit entry. When the sales taking place, it is a revenue. Always revenue is credited. Increase in revenue is credited. Okay. So number 8 is yes. Then but they have said this. We have sold 50,000 worth of goods. So what we have to do is we have to remove that 50,000 from the inventory. Cost of sales. Cost of sales. Sales 50,000. 50,000. Inventory has to be deducted, right? Inventory always has to be deducted, no, because when you issuing the goods, the inventory has to be deducted. Here, cost of sales, sales, cost of sales, cost of sales is debited. Inventory worth of 50,000. 50,000. Why? We have to remove the inventory. When the inventory is going out, it has to be reduced in the sense asset is reducing. If the asset is decreasing, there will be a credit entry for the asset, then we are passing the credit entry. It will affect the cost of sales will be debited because the inventory has been sold. Because of that, cost of sales is debited. And number 8 it inventory worth of 30,000 sold for 50,000 on credit. Trade creditors, right? Trade creditors. Okay, 50,000. Sales 50,000. Okay, trade creditors, trade debtors. Sorry, trade debtor, debitor. Okay, debit, credit, debit, credit, trade debtor. On debitor, we are removing. What is the entry we have passed? Sales account. Wait. Here we didn't put the narration. We are here cost of sales is 50. Then we have to say here cost of sales inventory. Okay. Sales account credit and trade debtors is debited because cash receivable. Okay. Sales account debited because we have sold the goods on credit. Goods have gone out, then inventory good has gone out for the sales. The sales is the revenue. Revenue always has to be credited. So we have credited here. Then the cash not yet been paid. It will be paid on the future because it was an credit sales. Then it has to be debited. Trade debtors has to be debited. Here we say debtors. Trade debtors. Trade debtors. Okay. Double entry is completed. Okay. So here trade debtors and sales had been affected. For adjustment number 8. Adjustment number 9 is inventory costing 12,000 was sold to 10,000. Inventory costing 12,000 sold for 10,000. Sales 10,000. Okay. Sales account 10,000 credited and inventory costing 12,000 sold to 10,000 cash. Cash 10,000. So cash account debited, sales account credited. Okay, we have to check here. Not cash here. We have mentioned wrong narration in there. $70,000 made on cash sales. Here we have to sales, sales. Here also we have to say sales. Sales 10,000 because we have sold it. Here we have to say cash. Sold it for 10,000 worth of goods. We have made a sales for 10,000 cash sale. Cash is coming in, sales income is going up. Sales income always credited, cash account always debited because cash is increasing in the sense it has to be debited. Okay, then but we can see on that is 12,000 worth of goods was sold, right? Goods value was 12,000. So inventory is going to affect. We have to remove the 12,000 from the from the inventory. Cost of sales 10,000, 12,000, right? Cost of sales 12,000 has to be removed from, here we will say inventory. 10,000, sorry, 12,000. Here also 12,000, right? Because cost of sales, the inventory has to be removed from the 12,000. 12,000 has to be removed from the inventory because that much of worth of goods had been sold for the 10,000. So when we make this entry, this also has to be made. Okay, and this is okay. This is okay. But here inventory worth of 30,000 sold for 50,000, right? 50,000 we have sold it for 50,000 debtors, and for that we didn't remove the inventory. So we had to remove the part for number 7. We have accounted number 8 accounted for only the sales. Okay, sales only the debtors account, sales account credit, debtors account debited. from the inventory we didn't remove that value of the sales, 30,000 worth of goods. Then we have to say cost of sales. Here we can cost of sales. Here say we can 30,000. 30,000. Here this area 12,000. 30,000 cost of sales, inventory 30,000. Understood? Okay. So what has happened in the number 8 adjustment is inventory worth of 30,000 sold for 50,000. So we have made an adjustment for the inventory. Sales account is credited and trade debtors account debited, but we didn't remove that part of sales part. Inventory part we didn't remove that. 50,000 with the sales made for 50,000 worth, the stock worth was 30,000. That has been removed. Cost of sales 30,000. Here we have made it to cost of sales and inventory was removed. Okay. Then inventory costing 12,000 was sold to 10,000. Cash account debit 10,000. Sales account credit 10,000. Now we are going to remove the inventory part. What is the cost of the inventory was 12,000. 12,000 we have removed from the inventory. It was credited and again cost of sales is debited 12,000. Okay, understood? So that is done. So inventory costing. The next adjustment number 10 is inventory costing 8,000 was sold to Y on credit for 7,000. Inventory worth of 8,000 costing 8,000 was sold for 7,000. Sales income 7,000, right? To whom we have sold? To Y on credit. Trade debtors 7,000. What is the corresponding in the sales account? Here we have to say sales 7,000. Here we have to say trade debtors. Trade debtors. Okay, that is done. But other adjustment is inventory. Inventory part we have to remove it. Sales we have made 7,000. We made the 7,000 sales, but the cost of that inventory was 8,000. So cost of sales sales 8,000, right? Here in the cost of sales inventory 8,000. Okay, we have removed the sales value inventory, sales value of that inventory value which was sold for the 7,000 had been removed. Okay, understood? Then number 11, received 15,000 from debtors. Received, when you receive the 15,000 from debtors means cash received from debtors, cash is coming in 15,000, debtors reduced by 15,000. Trade debtors 15,000, right? Reduced by the 15,000. Here the cash account is affected and trade debtors also affected. Here we will say trade debtors, trade debtors, thus here we will say cash. Okay. Then pay 20,000 to creditors. Okay. Trade creditors. Paid 20,000 to trade creditors. Okay. Trade creditors. Where is a trade creditor? If we are paying, cash is going out, right? Cash is going out means asset is coming down, decreasing. Then we have to pass a credit entry. Liability is also decreasing. Then we have to pay the pass a debit entry to the creditors. Trade creditors, cash, 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 trade creditors. Paid 20,000, right? 20,000. Here payment 20,000. We are here trade creditors. Here we will say trade creditors. Okay, trade creditors. We have made a payment worth of 20,000. Okay. Then the third next adjustment was 13th adjustment. Inventory costing 15,000 taken away by owner. It was the drawings account. We have to open a drawings account. Debit, credit, drawings. Okay, drawings account debited. What he says, inventory costing 15,000 taken away by the owner. Drawings account 15,000 and inventory account credited by 15,000 because 15,000 worth of goods taken away by the owner. Then here we will say drawings, right? Here we will say cost inventory. Okay, because uh, inventory, this drawings means drawings, the goods have been taken away by the owner, or the goods are going out. Then the if the goods are going out, in the sense assets are decreasing. If the assets are decreasing, it has to be credited. Assets has to be credited. So inventory is an asset, it has to be credited. We have credited. Here drawings account debited because it is receivable for us. Receivable in the sense assets. Assets has to be increased. So here receivables 15,000. The drawings is increasing. Okay. Next is adjustment number 14. Received rupees 10,000 as commission. So commission income debit DR and CR commission income income account, right? Commission income account, income, right? Credit. Income account credited with the 10,000 rupees, right? Cash account debited with the 10,000 because we have received a commission of 10,000. Cash account debited, commission income is credited. Commission income is the other income, right? Not a, the commission income is was not generated from the ordinary course of the business. It is an extraordinary cost. That's what we will say commission income. It will be categorized under the other revenue. Okay. Cash account, we have received the cash account is affected. Here cash account we will say commission income, commission income. Okay, 10,000. Next, adjustment number 15 says there is a receivable commission of 3,000, right? Then receivable commission account debit, dr, receivable commission. So yeah, receivable commission is debited to 3,000, right? And commission income is credited to 3,000 because income we have to receive that. We have to receive this income. So this is an income, other income. So here we will say commission. Here we will say receivable commission. Okay, receivable commission. Okay, because this revenue, this commission, not yet received by us. So anyway, we have to show it in accounts. So cash account, the commission account has to be debit, credited, and income receivable, commission receivable is debited. Okay, because commission receivable is an current asset. Okay, receivables is increasing in the sense assets increasing. It the commission receivable accounts has to be debited. Here commission income is increasing, always incomes are credited, revenues are credited. Okay, increase in revenues are credited. So that is done. Paid 8,000 as a rent for office rent, we'll say rent, debit and credit. Rent account, we have paid an rent of 8,000. We say rent account debit. We are the other account. Cash is 8,000. We have paid by cash because cash is going out. When the cash is going out, asset is decreasing, then it has to be credited. Asset has to be credited. Then cash is an asset. It has to be credited. Credit entry has been passed. Rent account, rent is an expenses. So we have paid an expenses. Expenses increasing. Any increase in expenses are debited. Okay, here we have debited. Corresponding entry, here we will say cash. Here we will say rent. Okay, and other thing is next adjustment is 17. Adjustment number 17. 5,000 payable as a rent for warehouse. 5,000 payable as a rent. Rent income, rent rent expenses debited 5,000, rent payable, here this is debit, credit, rent payable is credited. Why? The rent is current month rent, previous month rent still not yet paid. The rent belongs to the financial period, has not been settled within that financial period. So we have to treat that as an rent payable. Rent payable is the current liability. It is a liability. Then that rent is increasing. Then the rent expenses is increasing. Liability is increasing. If the liability is increasing, then it has to be credited. Okay, when the rent, when the expense, when we are paying the rent, it was an expense, so expenses always debited. Okay, expenses always debited, so we have debited the expenses. Here we will say rent payable. Rent payable, here we will say rent. Okay, both are telling. Okay, so adjustment number a 17 also finished. Adjustment number 18 is inventory sold on credit for 1,500. Cost of that is 1,000, returned by back by the debtor. Right? If the inventory was returned by debtor, we will assume that it was by the debtor, right? Inventory sold, sales return inwards. We will open an account, return inwards. Debited, this is credited, return inwards. Return inwards, right? Return inwards and inventory. In the return inwards, we will say inventory sold on credit for 1,500. Right? Return inwards is the sales return inward. It is the sales income is credited, then when it is returned back, then it is debited. So 1,500 sales return debited by 1,500, and we can say it was the cash sales, right? Cash refunded to them. Then we are paying back that cash pertaining to that returns 1,500 in the cash account. Okay, we will say return inwards. Okay, return inwards. Here we will say cash. Okay, have you understood the matter? Because the sale we have made and sale cash sales earlier. The person for an example, he had purchased around 8,000 or something like that. It was there in his cash sales, yeah, 70,000 worth of sales, cash sales, right? Out of 70,000 he is returning 1,500 worth of goods. So the sales has to be reduced. For that, we are passing the return inwards sales account debit, and cash account we are paying out that money equal to that return, that was 1,500 we have paid. Then we have to remove the cost part of the return, right? And we have to add it, that cost part of the return. 1,000 worth of goods had been returned. I mean, that means inventory account has to be added by 1,000, right? Cost of sales has to be reduced by 1,000. And here we will say inventory, here we will say cost of sales. This is for the return. Inventory sold on credit for 1,500, return back, right? This is for the return back, because then the inventory will increase, no? That's what it has been debited, and that particular 1,000 credited to cost of sales. Cash is there will be a two type of transactions here, two type of treatment for that. Here one type of treatment is sales amount. For the sales amount we have made a treatment. Next treatment is cost amount. For the cost amount we have treating the inventory. So next one is adjustment number 19. Inventory purchased for 2,000 was returned by business. Inventory. Then we will say here return outwards. Return outwards. Okay. Return outwards is credited by 2,000, and trade creditors is debited. Trade creditors. Where is the trade creditors? Trade creditors are debited with 2,000, because we have returned back 2,000 worth of goods we have purchased, right? Say for the sales purposes we have purchased 200,000 of worth of inventories. So out of that 2,000 we are returning. Here we will say return outwards. Okay, outwards. That's all. That is the double entry. So we have finished all the calculations here. Now we have to do the balancing part. When we are doing the balancing part, we have to see which side has a higher amount. For that we have to total it first, and this total, the after totaling that amount we have to put it here, other side we have to put it the other side, and see the balancing amount will be known as balance carried down, and otherwise that can be used as a balance brought forward. Now we will do the balancing item. Okay, I'll use the calculator. So here you can do the balancing. Very first account. Okay, you say here 500 1.1 110 180 190 100 205 225. No, 1,225,000. Okay, 1,225,000. So you can say 500 plus 600 plus 70 plus 10 plus 15 plus 10, 1,205. 500, 600, 70, 10, 15, 10. 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. 1,205. Right? Here also we will say 1,205. Right? Minus 350 minus 28 minus 1.5. 825,500. 825,500. This is balance carried down. This is known as balance carried down, the difference. Here we will say balance brought forward. 1,825,000. Okay. Here we will say 500 balance carried down 500,000. Okay, 500,000 balance brought forward 500,000. Right, bank loan also 600,000. So balance carried down is 600, 600,000, 600,000. Balance brought forward 600,000. Right, here furniture account, balance it 900,000. Balance carried down 900,000. Here also 900,000. Balanced it, and balance brought forward 900,000. Okay, furniture also like that. Here we'll say 700. Okay, here also carried down, balance carried down 700,000. Here we will say balance brought forward 700,000. Okay, so we will say next we need the calculator, without which we cannot proceed. Okay, So here, say this balance is 351,000. 351,000, right? Total. From that, here also we have to say 351,000. Okay, 351 minus 50 minus 30 minus 12 minus 8 plus 15, 236. Carried down balance is 236,000. This is balance carried down 236,000. Balance brought forward. Okay, here it is 200,000. Here it is 200,000. Here balance carried down 178,000. Balance brought forward 178,000. Here we will say 720, 137,000. Here we will say 137,000. Balance carried down 137,000. Here balance brought forward 137,000. Okay, here we'll say 50, 30, 80 and inventory 10, 30, 30, 80, 90, 98,000. 98,000. Here say 98,000. Balance carried down 97,000. Balance brought forward 97,000. Here we will say 57,000. So here say 57,000, out of which if we deduct 45, 15, then it will come around 42,000. Balance carried down. Here we will say balance brought forward. Brought forward is 42,000. Okay. Here again inventory 15,000, drawings 15,000. So balance carried down 15,000 and 15,000. Here balance brought forward 15,000. Okay. Here 13,000. Here balance carried down 13,000. Total is 13,000. Here balance brought forward 13,000. Right. Commission balance carried down 3,000 and 3,000, and here also 3,000. balance brought forward 3000. Right, cash. Here we'll say 13,000 rent account, balance brought forward, carried forward 13,000, then total is 13,000, balance brought forward 13,000. It is rent payable is 5,000. Here balance carried down 5,000. So 5,000. Here balance brought forward 5,000. Here balance carried down is 1,500. 1,500. Okay, 1,500. Here balance brought forward, sorry, balance brought forward 1,500. Okay, here return inwards. This is return inwards. We where we have transferred this return inwards. Trade creditors. Okay, outwards trade creditors. Okay, here balance carried down 2,000. Okay. 2,000, balance brought forward is 2,000. Okay, so this is the way of uh, what you called balancing. After preparing the T accounts, we have to balance it properly, right? All the T accounts has to be balanced. From that balancing figure only will come to the trial balance. Okay, trial balance. Okay, because when you are balancing the T accounts, you have to first of all see which side has a greater amount. That the side which has a greater amount, you have to total it, then put it to the other side and take the balancing figure. This is the balancing figure, right? Take the balancing figure as balance carried down. This is the balance carried down. This balance will brought to here, balance brought forward in the sense for the new year. This is the closing balance for that particular year. This is the opening balance for the particular period. Okay, closing balance carried down and balance brought forward will be the same amount. There won't be any difference, right? Both are same amount. There won't be any say differences. Okay, that you have to understand. So we have balanced all the accounts, T accounts. Now we have to prepare the trial balance. What is the trial balance? Trial balance is the list of ledger balances. Right? Trial balance is the list of ledger balances. Right? Both the trial balance debit side and credit side is there. Both sides should tally. Right? There won't be any differences. It should tally. Debit and credit should tally. Okay, here in the trial balance we have said ledger folio number column 1, Column 2 is description. Column 3 is debit. Column 4 is credit. Right? In ledger folio number, we will refer the ledger account. Cash is the ledger account. Drawings account is a ledger account. That ledger folio number. Now you don't need to know about this one. Now we can see the other business. So first we'll say the cash account balance. Cash account. Cash account. It's going to 825 debit. 825 debit. Then we'll go by this way, okay? Then capital. Capital account 500 broadband. Credit balance. Okay? 500,000. And bank loan also has a credit balance of 600,000. Okay, next one is furniture and fitting has a debit balance of 900,000. Furniture. $900,000. It is a debit balance. And other creditors has a 700 rupees balance. 700,000 credit balance. Okay. Other inventory has a balance of 236,000. Inventory. Inventory, or you can say purchase. Okay. Inventory has a balance of 200. This is inventory, not the purchase. Okay. Inventory has a balance of 236,000. Debit balance 236,000. Right. Trade creditors had a balance of 178,000. Trade had a balance of 178,000. Other one is sales. Had an balance has a balance of 137,000. Next one, cost of sales. Had a balance of 97,000. Debit balance 97,000. Okay. Not 97,000. This is 80, 50 and 30, 80, 80 and 12, 90 to 800. 100,000. Sorry, yeah. There was a mistake in the casting mistake. Okay. This one is a 100,000. This was 100,000. Here we will say 99,000. Okay. 99,000. 99,000. This one is 99,000. Okay. So mistake. and trade debtors had a balance of 42,000. Trade debtors had a balance of 42,000 DP, and drawings has a balance of 15,000 DP. Okay, debit balance. And commission income commission income is 13,000 credit. Revenues are credit. Okay, 13,000. And receivable commission receivable commission was 3,000. 3,000 receivable commission. And next one is rent account. Debit 13,000. Rent payable rent payable account credit balance 5,000. Return inwards account account 1,500 debit. Return outwards account account credit 2,000. Okay. Return RET to RN return outwards. So to extend this, okay. Let's see whether it is balancing. Okay. Use my calculator. First of all, we will balance the 8 825 500. Okay, 500 825.5 plus 900,000 plus 236,000 plus 99,000 plus 42,000 plus 15,000 plus 3,000 plus 13,000 plus 1,500. Then 2,135,000. Okay, 2,135,000. Other side is 500,000 plus 600,000 plus 700,000 plus 178,000 plus 137,000 plus 13,000 plus 5,000 plus 2,000. Okay, 2,135,000. So it is balancing in the sense we have done the double entries correctly. Okay, I think you would have understood the accounts here. And anyway, I will come up with the more exercises. This is the first exercise to see you for your how it's working. T accounts how it's working. Today you have learned how to pass the entries in the T accounts. Single way you have passed. Now whole accounts had been integrated. So here you learn today how to balance the T accounts and how to get the balancing figures, how to bring the brought forward balances, and how to prepare the trial balance here, right? So today's lesson is very important for you all. This is the very basic lesson. So I hope you all would have understood this one. If you have any queries, you can, without any hesitation, you can contact me through mail. Okay. Thank you very much. I hope to meet you in next lesson. So, thank you. Bye.